Are you ready for open enrollment? Do you understand your health insurance plan? Do you just pay your medical bills without checking them? Do you understand your health insurance plan well enough to dispute some medical charges with your insurance company? Do you have what it takes to make an informative decision on the insurance plan that is suitable for you and your family? Stay tuned. Hi teasers, my name is Linda, your money teaser. Here, I give money teasers on personal finances so that you and I can arouse our dreams. Today, I will talk about health insurance. I will explain some important terms you should know before signing up for your health insurance plan. And by the end of this video, not only will you know what to look for in a health insurance plan, but you will also understand how health insurance works. But first, if you are new here, please be sure to subscribe to my channel and turn on the notification so that you won't miss out on any video I publish. And when you subscribe, please type in the comment, "I subscribe," so that I will get to know you and thank you personally. Let's get started. Many Americans don't understand health insurance. As a result, many don't sign up for health insurance, whether it be privately or through their employers. Also, many that do sign up for health insurance don't even understand how it works. I've heard of people complain of paying medical bills while they have health insurance. To these people, they should never receive a medical bill for as long as they have a health insurance. What about errors? Has the thought of being billed by mistake ever crossed your mind? How do you check for mistakes if you don't understand how a health insurance plan works? How do you know which health insurance plan to choose for your family during open enrollment? If you're one of those that don't understand health insurance, this video is for you. In order to understand how health insurance works, you must first understand its jargon. But don't fret, there are only about 5 terms in the health insurance vocabulary that you need to know. Once you understand those terms, you will be able to read and understand any insurance plan, including dental and vision. And as a result, you might end up dropping that lower premium plan you've always chosen for years. Or you might be that person that will start disputing medical bills with your insurance company. The 5 terms of health insurance language you should master are the deductible, the co-insurance, the co-pay, the out-of-pocket maximum, and the premium. Let's start with the deductible. The annual deductible is the amount of money you must spend out of pocket on covered health services before your health insurance plan begins to pay for your medical care. One thing I want to stress on is the word covered. Just because you have a health insurance doesn't mean the health insurance company will cover all your medical needs and procedures. A good example would be plastic surgery that is not covered by most insurances unless there is a medical need for it. Likewise, a lot of insurance companies will not cover fertility treatments. Always read your insurance benefit guide in order to find out the medical services covered by your insurance plan before you signed up for it. Let's assume your health insurance annual deductible is $1,200. With such a deductible, you will be billed for medical services you received until you have paid a total of $1,200 out of pocket. In this case, we say that you have met your deductible. Let's say, for example, that you have a procedure that costs $2,000. If the procedure is considered not covered by your insurance plan, then you will have to pay the entire $2,000 out of pocket, and none of that will count toward your deductible. However, if the procedure is covered by your insurance plan, you will pay $1,200 out of pocket in order to meet your deductible before your insurance company kicks in to pay the remaining $800 of the bill. This leads us to the next term you need to know, the co-insurance. The co-insurance is the portion of the medical bill you have to pay after your deductible is met. Again, it only applies to covered health services by your insurance plan. The co-insurance is written in percentage and is usually predetermined in your insurance benefit guide. Once you have met your annual deductible, the insurance plan might or might not cover the entire medical bill. Usually, what is left of the bill after your deductible is met is shared between you and the insurance company, hence the word co-insurance. In such a case, the insurance plan will usually cover the larger portion of the bill. Let's get back to our previous example. We assume you have an insurance plan with the annual deductible of $1,200. We also assume that you had a medical procedure that cost $2,000. With this plan, you will have to pay $1,200 in order to meet your annual deductible. After that, your insurance plan kicks in the form of co-insurance. Now, let's assume that the procedure you had is covered by your plan with a co-insurance of 80-20 split. This means that after your deductible is met, your insurance will be responsible of 80% of the bill, whereas you will be responsible for 20% of your bill. In this example, the insurance company will pay 80% of $800, which amounts to $640, and you will pay 20% of the $800, which amounts to $160. I should note here that not all insurance plans have a co-insurance. If you happen to have a plan with no co-insurance, the insurance company will cover all your medical costs at 100%. But you must meet your deductible first. As I said earlier, the co-insurance is predetermined in the insurance plan. This simply means that you have the ability to know ahead of time how the bill will be split between you and the insurance company for every medical services covered by the plan. Hence, before you choose an insurance plan, I suggest you always take a look at your benefit guide to see when and how the insurance will cover you, especially when you have a medical condition. One thing not to do is confuse co-insurance for co-pay. Let's talk about co-pay next. Co-payment or co-pay is a low fee that you paid for covered medical care at the time of your medical appointment. The difference between the co-pay and the co-insurance lies in the fact that you usually pay a co-pay at the time of your service, whereas you are usually billed the co-insurance later. The copay is a flat fee that is standardized by the insurance company depending on the type of service you receive. For example, you might pay a $25 copay each time you see a doctor. You might also pay a $50 copay when you see a specialist. And you will pay a larger copay of as much as $300 if you visit the emergency room. Just like the co-insurance, not all plans require a copay, and when the copay is required, it is predetermined. Again, make sure to read your medical guide in order to see when a copayment will be required. Now, let's talk about the next term you should know, the out-of-pocket maximum. The yearly out-of-pocket maximum is the most you could pay out-of-pocket each year for services you receive. In other words, when you reach this maximum amount of dollar, the insurance company starts paying 100% of your covered medical bills for the rest of the year. Let's take a look into our example to better understand the concept of the yearly out-of-pocket maximum. We assume you had an insurance plan with the annual deductible of $1,200 and an 80-20 split as co-insurance. And we also assume that you had a medical procedure that cost $2,000. As a result, you will pay $1,200 out of pocket to meet your deductible. Also, with the 80-20 split co-insurance, you will have to pay an additional $160 out of the $800 balance, as the co-insurance insurance, while the insurance company will pay $640. To simplify things, let's assume that your plan has no copay for the services you received. That will make a total of $1,360 you will pay out of pocket for the service you received. Now, let's assume the yearly out-of-pocket maximum of your plan is $1,500. This means you are $140 short of reaching your yearly out-of-pocket maximum. Therefore, you will have to incur another medical bill of at least $140 before your insurance plan can now start to cover you at 100%. What if your annual out-of-pocket maximum is $1,300? In this case, the insurance company will pay the 80% co-insurance, which amounts to $640. But instead of paying the full 20% of co-insurance, which amounts to $160, you will end up paying less, because paying the entire $160 will make you spend a total of $1,360, which is $60 over your out-of-pocket maximum. Hence, you will pay $100 out of the $160 as co-insurance, and the $60 left will be the insurance company's responsibility. Here, you will pay a total of $1,300, and the insurance will pay a total of $700. And because you have reached your yearly out-of-pocket maximum, your insurance plan will fully pay all your medical bills till the end of the year, including co-pays. This is actually one of the reasons why healthcare facilities are usually very busy during the end of the year, because people with medical conditions know that their yearly out-of-pocket maximum will likely be met later in the year. Hence, they schedule all kinds of tests and procedures toward the end of the year, knowing that the insurance company would pay 100% because they have met their yearly out-of-pocket maximum. Costs that will count toward your yearly out-of-pocket maximum include costs that go toward your copay, your co-insurance, and toward your plan deductible. Unfortunately, expenses related to uncovered medical services and your premiums cannot count toward the yearly out-of-pocket maximum. This leads us to the next term you should know: your premium. The premium is what you pay the health insurance company in exchange of the health coverage offered to you. Hence, the premium you pay is your responsibility of the contract between you and the insurance company. In some instances, if you decide to choose a health insurance plan through your employer will cover some or all of your insurance premium. In this case, your employer will deduct your insurance premium out of your earnings before you receive your paycheck. And of course, if you have private insurance through the marketplace, you are responsible for paying your health insurance premium directly to the insurance company. The amount you pay in premium depends on some factors. Some of these factors are your annual deductible and your yearly out-of-pocket maximum. The lower your yearly out-of-pocket maximum, the higher your premium, and vice versa. Also, the lower your yearly deductible, the higher your premium. This is a popular choice taken by people with medical conditions, because these people would like to meet their deductible quickly so that the health insurance plan will kick in as soon as possible to cover for their medical expenses. Likewise, the higher your yearly deductible, the lower your premium. This is the plan chosen by healthy people. Because these people barely fall sick, it makes no sense for them to pay high premiums, even if the plan comes with a high deductible. After all, they barely go to the hospital, hence it is okay to have a high deductible plan. This is the case of health insurance plans that come with a health savings account, also known as an HSA. The health saving account is a plan that comes with a high deductible insurance plan, hence low premiums. For the insurance plan to be qualified as a high deductible plan, it must meet some requirements set by the IRS in terms of minimum deductible and maximum yearly out-of-pocket allowed. Once you sign up for a high deductible insurance plan, you can create a health savings account. Some employers will incentivize their employees with money upon the creation of such an account. And as an employee, you can choose to contribute additional money into your HSA. The health savings account comes with some tax benefits. 1. Contribution into the HSA are pre-tax if done by the employer or tax deductible if done by the employee. 2. You have tax deferment growth on your contributions. And 3. You are allowed to make tax-free withdrawals from this account for eligible health-related expenses. Do not confuse HSA for FSA, which stands for Flexible Spending Account. Just like an HSA, an FSA is also used for qualified medical expenses. However, there are some key differences between these two accounts. Unlike the health savings account that is only made available to people with high deductible insurance plan, the flexible spending account is available to anyone that is interested in it. Moreover, contributions into an HSA grow at very low interest, whereas contribution into the FSA have no growth. Also, unlike the HSA balance that can roll over from year to year, with the FSA, you run the risk of losing your money if you do not spend it all by the end of the year. Keep in mind, you cannot contribute into both accounts at the same time. Another important term I would like to talk about is the term network, which healthcare providers usually use using the expression in-network and out-of-network. The health insurance network is a group of doctors, pharmacists, and healthcare professionals from multiple specialties that sign a contract with an insurance plan to provide healthcare services to the members of the insurance plan. When a healthcare provider is part of your insurance plan, that provider is considered a participating or an in-network provider. Likewise, all other health insurance providers that are not part of your insurance plan are considered out-of-network providers. So, in-network, out-of-network, why should we care? In order to be part of a health insurance network, health insurance care provider must meet some requirements, including agreeing to accept a discounted rate for covered services. Therefore, when you see a doctor who is in network, he or she offers you medical services at a discounted price, hence a lower medical cost. However, if you see a provider that is out of network, expect to pay more for your medical care. Now, to put everything into perspective, here is how health insurance works. When you go to the doctor's office, you might or might not pay a copay depending on the type of insurance plan you have. Then, after the doctor sees you, you will receive a medical bill which will be discounted if your medical doctor is in network. If your annual deductible isn't met, you will pay a portion of your bill or the entire bill until the deductible is met. Once the deductible is met, the insurance plan kicks in and shares the cost of your bill with you. Keep in mind, you will keep on paying co-insurance after your deductible is met until you meet your yearly out-of-pocket maximum. Once you meet your yearly out-of-pocket maximum, your insurance plan will fully cover all your medical costs for the remainder of the year for as long as your medical services are covered services under your insurance plan. Teasers, I hope you have enjoyed this video and I hope you are better prepared for open enrollment. I highly suggest you watch this video next. If this video has been of any value to you, please like, share, and subscribe if you haven't done so yet. And please let me know your thought below. I would love to read from you. Thank you for watching and see you in the next video.